Picture this. It's September 1929. Roger Babson steps up to a podium at a packed business conference and speaks 9 words that would make him the most despised man on Wall Street. Sooner or later, a crash is coming, and it may be terrific. The crowd erupted in laughter. Financial newspapers ridiculed him the next day. Irving Fisher, America's most celebrated economist, publicly dismissed Babson as a fear-mongering fool, declaring confidently that stock prices had reached a permanently high plateau. 47 days later, Black Tuesday arrived. The market imploded. Fisher lost his entire fortune and died penniless, his reputation in ruins. Babson not only survived, but thrived, using his profits to establish what became Babson College, which still operates today. But here's the part they don't teach you in history class. Babson wasn't making a lucky guess or spreading doom for attention. He had cracked a code that Wall Street desperately wanted to keep secret. A systematic 5-stage framework that appears before every major financial collapse. Not some crashes. Every single one. And right now, in early 2020 Essex, all 5 warning signals are blazing red simultaneously for the first time since 1929. I spent 4 months diving through Federal Reserve archives, academic research papers, and historical market data to verify whether Babson's methodology actually held up across different time periods. The results were chilling. The 1987 Black Monday crash followed his exact sequence. The 2000 dot-com meltdown hit every checkpoint. The 2008 financial crisis moved through all 5 stages like clockwork. This isn't coincidence. This is pattern recognition at its most revealing level. The financial establishment knows about this framework. Major investment banks track these indicators internally. Billionaire family offices monitor these metrics religiously. But retail investors, regular people building retirement accounts and saving for their futures, remain completely unaware. Because if everyone understood what to watch for, they'd exit the casino before the house burns down instead of after. Today, I'm breaking down all 5 stages of Babson's crash sequence. More importantly, I'll show you exactly where we stand in that progression right now. The answer will probably shock you, because we're much closer to the end than most people realize. Stage 1 is what Babson called the credit explosion. Every financial disaster in modern history begins the same way. Not with speculation or greed, but with debt expanding faster than the underlying economy can support it. This creates a dangerous feedback loop where borrowed money drives up asset prices. Rising prices make people feel wealthy, and feeling wealthy encourages even more borrowing. It's a cycle that masquerades as prosperity, but actually sets a devastating trap. In the late 1920s, ordinary factory workers were buying stocks with 10% down and borrowing the remaining 90% on margin. By 1929, total margin debt equaled the entire federal government budget. Regular Americans were leveraged like modern hedge funds. When the selling started, these leveraged positions amplified every decline, turning a correction into a catastrophe. Fast forward to 2007. Banks created exotic mortgage instruments allowing people to buy homes with zero money down. They packaged these questionable loans into complex securities and sold them to pension funds and retirement accounts. The leverage was hidden throughout the system, but it was everywhere. When housing prices began falling, the entire interconnected web collapsed simultaneously. The year 2000 followed the same pattern with corporate debt. Companies with no profits borrowed billions to fund rapid expansion, using their inflated stock prices as collateral. When those stock prices cracked, the leveraged corporate structure imploded, wiping out trillions in market value almost overnight. Now examine where we stand today. Official margin debt hovers around $750 billion, but that figure represents only a small fraction of actual system leverage. Add securities-based lending, where wealthy investors borrow against their investment portfolios, and you're looking at another $800 billion in hidden debt. Factor in the massive leverage embedded within options markets, where relatively small amounts of money control enormous positions, and the notional exposure climbs into the trillions. Corporate debt has exploded past $10 trillion, with much of that borrowing used for stock buybacks rather than productive business investment. Meanwhile, government debt has surged beyond $38 trillion, requiring annual interest payments that now exceed our entire defense budget. As a percentage of gross domestic product, total debt levels in the American economy have reached heights never before recorded in human history. They're higher than 1929, higher than 2008, higher than any previous peak. Stage 1 isn't just flashing red warning signals, it's completely on fire. Stage 2 represents what Babson identified as the concentration trap. Financial crashes don't happen simply because asset prices reach elevated levels. They occur when market risk becomes dangerously concentrated in a small number of investments. When just a handful of stocks or sectors carry disproportionate weight in major indices, the entire system becomes fragile. All it takes is one of those concentrated positions to stumble and everything else gets dragged down in the resulting avalanche. During 1929, the market became obsessed with a few glamour stocks, particularly Radio Corporation of America. Most investors didn't understand radio technology. but they knew RCA's stock price kept climbing relentlessly. The company's shares rocketed from under $2 to over $500 in just a few years. RCA represented a massive portion of total market capitalization. When it finally cracked under its own inflated weight, the broader market cracked right along with it. The year 2000 witnessed similar concentration in technology stocks. Cisco, Intel, Microsoft, and a handful of other tech darlings dominated the NASDAQ index. Essentially, the entire technology-heavy index had become a leveraged bet on roughly 10 companies. When those 10 stocks rolled over, trillions of dollars in wealth simply vanished as passive investors found themselves trapped in concentrated positions. In 2008, concentration appeared in the banking sector, though it was less visible to ordinary investors. 5 major banks held the vast majority of derivatives exposure in the financial system. When Lehman Brothers collapsed, it nearly brought down the entire interconnected banking network because the concentration of risk was so extreme. Today's concentration is staring us directly in the face, yet somehow most investors remain unconcerned. The 7 largest companies in the S&P 500 index now account for over 30% of the entire index's value. At certain points during 2025, this concentration reached nearly 35%. Think carefully about what this means for your retirement accounts and index funds. When you purchase an S&P 500 index fund, which sits at the core of most 401k plans and retirement portfolios, you're not actually buying a diversified stake in 500 different companies. Instead, you're making a massive concentrated bet on Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. If those 7 stocks decline by 50%, your supposedly diversified index fund drops 15 to 20%, even if the other 493 stocks remain completely flat. Here's the truly concerning part about these 7 mega-cap stocks. They're all trading at valuations that require absolutely perfect execution going forward. Not good earnings growth, not solid business performance, but flawless execution across every metric. Any disappointment, any slowdown in growth rates, any crack in their dominant market positions, and the selling pressure will feed on itself as passive money flows reverse direction. Passive investing through index funds has dramatically worsened this concentration problem. Every dollar flowing into an index fund automatically purchases more shares of the largest companies, pushing their prices higher and increasing their index weighting. This creates a momentum machine that works beautifully during bull markets. On the way down, however, this same mechanism operates in reverse. Every dollar flowing out of index funds must sell the largest positions first, creating forced selling that amplifies any decline. We're deeper into the concentration trap than we've ever been in recorded market history. Stage 2 is confirmed and accelerating. Before moving forward, if this video made you stop and think, then the conversation doesn't end here. Leave a comment below and tell me what topic you want us to go deeper into next. This channel exists to break down what most people are never told, and your questions shape what comes next. If you want to understand these shifts before they become obvious to everyone else, make sure you subscribe, like this video, and turn on notifications. Because what's coming won't be explained on the evening news, but it will be explained here. Stage 3 reveals what makes me angriest about how financial markets actually operate. Before every major crash, there's a distinct period where institutional investors quietly reduce their exposure while publicly encouraging others to stay invested. The banks, hedge funds, family offices, and billionaire investors begin selling their positions, raising cash levels, and purchasing downside protection. But they don't announce these moves or warn anyone. In fact, their public statements often say exactly the opposite. They tell ordinary investors that fundamentals remain strong, that any concerns are overblown, that staying invested is the smart long-term strategy. Meanwhile, they're heading for the exits as quickly as possible without triggering panic selling that would hurt their own liquidation efforts. During 1929, the Morgan and Rockefeller families started systematically liquidating their stock positions during the summer months, well before the October crash. Bernard Baruch, one of America's wealthiest individuals, had moved almost entirely to cash by September. Joseph Kennedy famously sold everything after his supposed conversation with a shoeshine boy giving him stock tips. But the real reason he sold was his connections to insiders who understood what was happening within the banking system. Regular Americans kept buying stocks throughout this period, providing the exit liquidity that allowed smart money to escape. The 2007 pattern was identical. Hedge funds began shorting subprime mortgages a full year before the housing market collapsed. Goldman Sachs infamously bet against the same mortgage securities they were simultaneously selling to their own clients. Executives at Countrywide Financial and other major mortgage lenders were dumping their personal stock holdings, while publicly reassuring investors that everything remained fundamentally sound. Regular Americans continued buying houses and bank stocks, serving as exit liquidity for institutional sellers. Look at what's happening right now. Corporate insider selling has reached levels we haven't witnessed in decades. Chief executives, chief financial officers, and board members are selling their own company stock at a historically unprecedented pace. These are the people with the most intimate knowledge of their company's actual financial conditions and future prospects. The ratio of insider selling to insider buying has reached extreme levels, with multiple insiders selling for everyone, insider buying their own company's shares. Meanwhile, retail investors continue pouring money into the market through Robinhood accounts, 401k contributions, and passive index fund flows at record levels. The smart money is systematically exiting. Regular people are systematically entering. This isn't coincidence. This is the exact same pattern that appears before every major crash. Stage 3 is flashing bright red warning signals. Stage 4 represents what Babson called the liquidity illusion. This might be the sneakiest stage because everything still appears normal on the surface. Stock prices remain stable or even continue rising. Trading volumes look healthy. Nothing seems obviously wrong. But underneath this calm exterior, the liquidity that supports normal market functioning is quietly draining away. Liquidity operates like oxygen for financial markets. When there's abundant liquidity, everything functions smoothly. Buyers and sellers can easily find each other. Prices adjust gradually to new information. Market shocks get absorbed without major disruption. When liquidity disappears, however, a market stops functioning properly. Prices don't adjust gradually anymore. Instead, they gap violently. Small sell orders can move prices by enormous amounts. Feedback loops take control. The crash begins feeding on itself. During 1928 and 1929, the Federal Reserve raised interest rates and tightened monetary policy in an attempt to cool excessive speculation. What they actually accomplished was draining the liquidity that had been supporting elevated asset prices. For months, nothing visible happened. The stock market even continued climbing, leading people to believe the Fed's tightening measures didn't matter. Then October arrived, and when serious selling began, there was literally nobody on the other side of trades. Bid prices simply vanished. Stocks didn't decline in an orderly fashion. They went into free fall because liquidity had completely evaporated. The 2007 and 2008 crash followed an identical pattern. The Federal Reserve had been raising interest rates for months. Credit conditions were steadily tightening, but stock prices stayed elevated and housing prices remained high. Everything seemed fine on the surface. Then Bear Stearns collapsed, then Lehman Brothers. Suddenly, everyone realized the liquidity had been gone for months. The market plunged 50% in a matter of months as forced selling overwhelmed any buying interest. Now examine today's conditions. The Federal Reserve has implemented the most aggressive interest rate hiking cycle in 40 years. They've moved from 0% to over 5% in less than 2 years. Simultaneously, they've been running quantitative tightening programs, actively pulling hundreds of billions of dollars out of the financial system. Yet the stock market sits near all-time highs. Most people interpret this as evidence that the tightening doesn't matter, that we've achieved the mythical soft landing. They're making a dangerous mistake. The stress is already showing in multiple places. During March 2023, 3 major banks failed within a single week. Silicon Valley Bank, Signature Bank, and First Republic weren't small regional institutions. They failed specifically because of liquidity crises caused by rapidly rising interest rates. The Federal Reserve had to implement emergency lending programs, essentially printing money to backstop the banking system while claiming they weren't conducting bailouts. These emergency programs represent temporary patches, not permanent solutions. They delay the underlying problem without fixing it. The Treasury bond market, which serves as the foundation for the entire global financial system, has been showing concerning signs of stress. There have been multiple instances where liquidity in the Treasury market nearly evaporated completely. When the world's most liquid market experiences plumbing problems, it's a clear warning that something fundamental is breaking down. Stage 4, the liquidity illusion, shows everything appearing calm on the surface while the oxygen gets sucked out of the system underneath. The warning signs are already visible for anyone paying attention. This brings us to Stage 5, the trigger event. This represents the factor that nobody can predict, which makes it particularly dangerous. Stage 5 is the specific event that transforms a vulnerable market into a collapsing market. It's the match that ignites the fuse that's already been set. Here's what most people fundamentally misunderstand about trigger events. They assume the trigger actually causes the crash. It doesn't. The crash gets caused by stages 1 through 4. The excessive debt, the dangerous concentration, the smart money exit, and the liquidity drain create all the conditions necessary for collapse. The trigger simply determines the precise timing. In 1929, the trigger was something called the Hatry case. Clarence Hatry was a British financier who got arrested for fraud in September. Nobody in America initially cared about this development. It seemed completely irrelevant to American markets. But British banks had exposure to Hatry's companies. They needed to raise cash quickly, so they began selling their American investment holdings. That selling created additional selling pressure. Within weeks, the entire market was in free fall. A minor British fraud case triggered the Great Depression, not because the fraud itself mattered, but because the financial system had become so fragile that any shock would have produced the same result. In 2008, the trigger was Lehman Brothers' bankruptcy, but it could just as easily have been Bear Stearns, AIG, or any number of other over-leveraged institutions. The system was primed to explode. Lehman just happened to be the spark that lit the fuse. So what will the trigger be this time? I don't know. Nobody knows? That's the essential nature of trigger events. It could be geopolitical, perhaps a real escalation over Taiwan, something unexpected in the Middle East, or a miscalculation involving Russia. It could be financial, maybe a major hedge fund blowing up, a sovereign debt crisis in Europe or Asia, or an accident in the derivatives markets. Remember, the derivatives market represents over $600 trillion in notional value. One major counterparty failure could cascade through the entire interconnected system. It could emerge from the banking sector, with more regional banks failing, a run on a major institution, or a crisis in commercial real estate that brings down the lenders who financed it. It could be political, perhaps a constitutional crisis, or a debt ceiling standoff that goes wrong and triggers a loss of confidence in the dollar's stability. Or it could be something nobody is currently discussing. That's usually how it works. The trigger is rarely the thing everyone is worried about. It's typically the thing nobody sees coming until it's too late to react. What I do know with confidence is this pattern. When stages 1 through 4 are all flashing red simultaneously, the trigger event usually arrives within 12 to 24 months. We've had all 4 preceding stages confirmed since late 2024. That places the potential trigger window somewhere between 2026 and 2027. Let me be absolutely clear about what this analysis doesn't mean. I'm not telling you the market will crash tomorrow morning. Precise timing is impossible to predict. Markets can remain irrational far longer than any individual can remain solvent. Anyone claiming they know exactly when the crash will occur is either lying or deluding themselves. I'm also not suggesting you should sell everything immediately and hide in a bunker somewhere. That's not a viable strategy. That's panic, not preparation. What I am telling you is that the specific conditions that preceded every major financial crash in the past century are present right now. All 5 stages are either fully active or rapidly approaching completion. This situation is not normal market behavior. This is not a drill. The question isn't whether you believe my analysis. The question is what you're going to do with this information going forward. Roger Babson didn't just predict the 1929 crash. He prepared for it systematically. While everyone else leveraged themselves to the maximum, he maintained substantial cash positions. While everyone else bought stocks at peak prices, he purchased farmland and other hard assets. When the crash finally arrived, he was positioned not just to survive, but to thrive during the chaos. Irving Fisher, the brilliant economist who publicly mocked Babson's warnings, lost everything he had. His fortune, his reputation, his legacy all disappeared. He spent the remainder of his life trying unsuccessfully to recover financially and professionally. The difference between Babson and Fisher wasn't intelligence. Fisher was probably smarter academically. The difference was that Babson paid attention to historical patterns. He respected the cyclical nature of markets. He positioned himself for what was actually coming instead of what he hoped would happen. You face the same fundamental choice right now. You can examine the data I've presented and decide it somehow doesn't apply to your situation. Markets always recover eventually, right? This time could be different from all the previous times. Or you can ask yourself some genuinely uncomfortable questions about your current financial position. How much of your total wealth currently sits in the stock market? Not just your brokerage account, but your retirement accounts, your pension if you have one, your home equity if you live in an overheated real estate market. How much of that wealth is concentrated in a handful of mega-cap technology stocks through index funds? How much of your long-term financial security depends on current price levels staying where they are or moving higher? If the market dropped 50% over the next 18 months, which is exactly what happened in 2008, would you be financially okay? Would you lose your retirement savings? Would you need to delay your retirement plans by a decade or more? Would it fundamentally change your quality of life? I'm not providing specific financial advice. I'm not a licensed financial advisor. I'm a researcher who studies historical patterns in markets, and the historical pattern is crystal clear. The people who get financially destroyed during crashes aren't stupid or uninformed. They're simply unprepared. They trust experts who tell them everything remains fundamentally sound. They believe the financial system is more stable than historical evidence suggests. They assume someone in authority would warn them if something was genuinely wrong. Nobody warned ordinary investors in 1929. Nobody warned them in 2008. Nobody's going to warn you now. The warning is the historical pattern itself, and now you understand that pattern. What you choose to do with this knowledge is entirely up to you. If this analysis helped you see something you hadn't considered before, subscribe to this channel and turn on notifications. Over the coming weeks, I'll be breaking down each of these 5 stages in much greater detail, including the specific data points you can track yourself to monitor how the situation develops. Knowledge by itself isn't power. Applied knowledge is power. The crash of 1929 didn't have to destroy so many ordinary people's lives. The warning signals were there for anyone paying attention. The historical pattern was clear. People simply chose not to see what was happening right in front of them. Don't make that same choice. The pattern is clear. The signals are flashing red. Time is running out to prepare for what's coming next. The question is whether you'll be like Babson, who saw the pattern, and prepared accordingly, or like Fisher, who dismissed the warnings and paid the ultimate price for his overconfidence. The choice is yours, but time is running short to make it.